Despite ongoing myths about Forex volatility, the Forex markets are actually one of the most stable markets to trade in, being only one step below fixed income products, bonds, US Treasuries, etc., in price consistency. These graphs show a 9-month price variation between currencies in various other markets. We'll use the US-Euro pair as typical currencies that are most often traded. This chart compares the price fluctuations for these currencies versus the S&P 500, versus the Dow Jones Industrial Average, versus petroleum, and versus gold. As you can see, currencies tend to fluctuate no more than other markets and actually show a nice trend curve similar to gold. Here's 2 points to consider about the stability of Forex trading. 1. Currency trades often last no longer than a day. This means a drop in value of a currency over a month's time isn't a significant factor since we're only really concerned with what the price of a currency will be tomorrow. In this case, we're more concerned about the volatility of a currency over a very short time span. The currencies Forex traders work with rarely shift in value more than 1% in a single day. Stocks can easily vary 5 to 10% in a single day of trading. 2. Trending is actually a useful aspect of Forex trading. If the US dollar is generally falling in price against the euro, that means the euro is trending upward and might represent the safer buy. Why is this the case that currency prices vary only moderately over time? 1. 85% of currency trading is with coin belonging to stable governments with low inflation. With so much profit to be made in established countries, there is no need to stray to riskier pastures. Betting on a wild increase in the Rwandan franc too many times will eventually catch up with the trader and end that illustrious career very quickly. 2. The size of the currency market is immense, with $4 trillion exchanged daily. That's $4 trillion daily. As is true in any market, stocks, commodities, real estate, and treasuries, the larger the market, generally, the less volatility there is in that market. A company with only 1,000 shares of stock can see a larger variation in price than a company that has 1 million shares to spread around. Because of this inherent stability and the preference for countries with stable governments and financial institutions, a single currency rarely just collapses like it can in real estate or stocks. Again, you will rarely see a currency drop more than 1% in a single day. You will never see an across-the-board bear market, since one currency always goes up in relationship to another currency going down. In the stock or real estate market, stocks will generally move en masse, with all sector stocks going up or down in a single news cycle. For example, if end-of-the-year computer sales are way down, most software companies might experience a similar downward shift. The Forex market is also far less vulnerable to fraud and manipulation than other markets. Mutual funds tend to be a black hole. They will give you daily account estimates, but actual trade history and commissions are reported on a monthly or quarterly basis. With most Forex accounts, you can view trades and commissions on a daily basis. We do trust mutual funds to provide accurate trade results eventually, but it's a comfort with Forex and commodities to be able to monitor exactly what was bought and sold and how much it cost online minute by minute. Also, stock values are too easily manipulated. Think Enron, WorldCom, Madoff. Overzealous accounting is just too tempting for a company wanting to show off inflated values and attract investors. Also, large brokerage companies can move a substantial amount of funds into or out of a company's stock to manipulate that stock's value if it benefits them. In contrast, the Forex market is too large and too well monitored by traders and centralized banks looking to make smart investments. Accountants don't decide how much the euro is worth versus the yen. Market forces decide how much a currency is worth. Therefore, it is nearly impossible to manipulate a currency's value. Consider that the vast amount of foreign exchanges are executed by large central banks and governments, not shady dealers or fringe market traders. This is a credible market which many large banks make much of their profits from. Why then, with all of this, is it possible to profit so much in the Forex market versus the traditional markets? There are three main reasons so many players operate in the Forex market. 1. You can make profits in any market. If one currency's value is going down, it's in response to another currency going up in value. In the traditional market, if IBM goes up 20% one month and down 8% the next, its net return is 12%. With currencies, you could have made 20% one month and another 8% the next, for a net return of 28%. 2. Since Forex trades occur on a daily basis, you are actually compounding your results daily, since the daily profit is immediately available for the next day's trades. With a mutual fund, trades go on for a much longer time period, and compounding is generally based on a monthly return. Starting with $10,000 at a 7% monthly return, compounding monthly yields 7%. Compounding weekly yields 7.18%, and compounding daily yields 7.45%. That's an additional roughly 0.5% per month with daily compounding. Over time, that adds up. 3. The main reason that a good trader can profit so much in the Forex market is that you can leverage Forex trades much more than you can in the stock market. Trading in stocks, you're generally limited to a 2-to-1 ratio of trading, where $100 can purchase $200 worth of stock. Day traders can leverage a bit more in certain circumstances, but in the Forex market you can leverage up to 50-to-1, so $100 can buy up to $5,000 of currency. This is, of course, good and bad, and why novice traders lose their shirt in the Forex market. If you bought $5,000 of currency with your $100 and that currency dropped 2% in value, then that $5,000 is now worth $4,900. That's not a huge loss, but there went the entire $100 you invested, so you have suffered a complete loss on just a 2% drop in value. Expert Forex traders know all the mechanisms and how to limit trade losses, which is the name of the game in the Forex market. Stop losses and 24-hour-a-day monitoring of their purchases allows the good Forex trader to minimize losses and maximize highly leveraged profits. They have the time, staff, and systems to do the market research and know as well as is possible which opportunities are ripe to bet on, and to watch their trades on a minute-by-minute basis if necessary to know exactly when to get out. Your average day trader just doesn't have the time and resources to face this market without suffering an eventual sizable loss. Because of this, we only recommend finding and utilizing expert traders. We would never recommend anyone try this out on their own. We also recommend you only risk amounts you can comfortably live without for a long period of time. You need to be in a position to weather the ups and downs of aggressive trading that will have its down months without panicking. We are fortunate to know trading systems that are earning consistent, high monthly returns beyond anything the traditional markets are currently delivering. For example, our favorite Forex system has netted over 7% monthly on average for over 4 years, and so far has had only 3 months of losses, with the largest loss at less than 9%. So do your research and decide if you're comfortable participating in this market. Adding a Forex trading system to the aggressive portion of your portfolio can do wonders for your financial goals and help reduce that 30-year retirement plan to something reasonable. To find out how you can enjoy substantial and consistent profits in your own alternative trading portfolio, please see our other videos or go to our site to learn more.